Hello everyone. Today I'm going to be showing you how do you know how to identify basically the high resistance signatures in price action. Excuse me. So I'm going to be highlighting a few things, the fair value gaps. We use the fair value gaps to actually identify high resistance signatures or to identify whether or not the day that you'll be trading is gonna deliver like smooth price action, or it's gonna be very choppy or sloppy. And what do you're also gonna be looking at the calendar as a roadmap, which is what I normally use. There's like a day prior CPI or a day prior and NFP. You usually get these kind of signatures in price. So if you are going to be trading those on those days, you need to focus on a few things. You need to focus on the opening range gap. If it's like very small, you want to stay away because already it's showing you that there is no volume, so to say, in the market. So when you open with such a small opening range like today here, this was the first sign. And also you look at it's a day prior core CPI, because if you look, this is Tuesday. I look down here, Tuesday, the 12th of November 2024. This is the day that I'm talking about. So it's a day prior core CPI. So normally the market will just consolidate, during the New York Open session or New York Open kill zone, because they are building up liquidity for the following day, which is in this case it's the um, CPI the following day. So you focus on how the market, how long does price stay inside the fair value gaps. That's also very important. You don't want to sell as soon as because I sell. That's my model. I use fair value gaps in most cases for my entries. So I want to look at the first candle that's going to go inside the fair value gap. I don't want to see it spend too much time inside the fair value gap, because if it does that, then it's tipping its hand to say, hey, I have no urgency to go anywhere, so I might be going up and down basically. So you want to then trade the macros, so to speak. But today I saw the silver bullets. It was just a few minutes before the macro, so that's the trade I took. That's why I was able to profit from such a ranging market. So I'm not going to talk too much about the bias, because you don't really need to uh, you don't really need the bias to trade the silver bullet. You just need to study the opening range, which is like the 9:30 to 10 o'clock price action. And that's what I actually have here. I have the opening price at 9:30 that gave me an opening range gap low, and then the closing price yesterday, which is closing price at 4:14. That's the regular trading hours close, which is opening range gap high, because on regular trading hours that's the closing price and this is the opening price. So this is the gap. If the gap is too small, that's another first sign that price is going to be ranging during the New York AM session. It's going to find it very hard to leave the opening range, this opening range. So as you can see here, we were just trading inside the opening range throughout almost throughout the whole of New York AM session. Price found it really hard to leave this range here. So that's sorry if you have some noise in the background. My wife is, doing the dishes in the kitchen, so sorry about that. So what you want to focus on is the last ditch macro, which is what I highlighted here, because that's, if there are no news event, no, if there are no red folder news events, that's what you want to be trading. The last ditch macro will give you some some displacement. even on days like this. So if the market structure is good, then you should trust it. All right, so you rely on that, not to trust it, but we rely on it if you really want to be out there pressing the buttons. So if you focus here, we actually generated liquidity. This low failed to take out that swing low, so that created what relative equal lows when you opened, and then we went higher, and then that buy side was taken out. This is a bearish market structure shift right there, and also right here. So it makes this low a low hanging fruit. This is just, I view this as a retracement, because already if we are going to go higher, at least this should be tagged, because it has what created a bearish market structure shift, so it should be cleared, and then you should see a rally to the upside. So when this happened, when we cleared this buy side here, and if you look at time, it was 10:38, and I saw that drop. I was like, okay, I think since we closed below that, up two consecutive up close candles, when this candle opened, I short this as my bearish order block, right? And then it created a fair value gap. I was watching this as we go into the last stage macro, which begins at 10:50. And if you look at 10:50 somewhere here, that's when the run started. And it went to what? This sell side here, as anticipated. But below that, I had these smooth lows here. So I said, no, I'll offload three contracts below that. And that's what I did there, because I had sold four contracts at that price. So I was able to just profit and take a clean trade, even though it was not, just straightforward day, for most traders. But because I am aware of these conditions, and I was able to just, leave, not take this sell right here, which is also good if your stop loss is going to be up maybe here. It was also good, but because I was actually waiting for the macro, and I could see the signature, and it was just a few minutes before the macro, I trusted that, because we had what? A sweep, a new buy side liquidity sweep, and we had the change in state of delivery right there. This is a change in state of delivery. I did not write it because um I don't want to have too much on my chart, but I was watching that, and I'm also looking at the closing price at on regular trading hours. I almost got that feel, because the feel here was at 21 126.8, and this is 21 130.8. It's just a few ticks short, and the difference is just a few ticks. So that's the feel I was hoping to get. And then on a good day, I was just gonna melt and never look back. But because of this calendar day right here, a day prior CPI, they had to do this, They just denied me that entry, and then, but it's okay, it's okay. But because this fair value gap held price, and you look at the bodies of the candles, they found it really hard to close above this closing price right here, which is good. That was another good signature. That's what I was looking at. And then once you saw a sell-off, and then price really started to, because it was now doing what? The last stage. So you focus on use the macros, you trade the macros, so that you are, you don't have to sit through this terrible price action. You just get the move, and the rest is history. So this is what I was actually looking at. And I offloaded. This was actually traded out because my stop loss was somewhere above these highs somewhere here, because this is the candle that took me out. I think it was somewhere above mean threshold of this other block, and it hit me out, because I was hoping to get my take profit was down here on this line here, so I couldn't get that. If you look at the retracement, you got so much turtle soup, it'll give you a turtle soup, creates a high comeback, because it's a fucking what? High resistance. Okay, this it failed. I'm sure it made SMT with ES. ES maybe did turtle soup that high. And then the same thing here, same thing there, turtle soup. The same thing there, turtle soup. Like even this high here, turtle soup. Those are the conditions. Even this was a turtle soup entry right there, because it failed to close above that. You know, when the market structure was already bearish, it was actually a good day if you're on site. You know, if your bias was on site, you could see these things. But if your bias was also wrong, then it definitely got hard for most traders out there. But this is how you look at this thing. If you look at the time it spends inside the fair value gaps, that's like it tells you how like I'm actually sloppy. Look at that fair value gap right there. Look at how many times, even the candles closing outside the fair value gap. Normally, that's not what you want to see when you're bearish. You want to see it roll over once it fills the fair value gap. You want to see it what roll over. But look at that. The body stayed closed above, head to tail that. Boom. The fair value gaps are not holding price, so you need to be using a bigger stop losses. Actually, you need to avoid such days, basically. That's like the best thing you can do, and you come back tomorrow after core CPI, because also London will be doing something similar to this, if not worse than this. So you want to be very careful, and this is how you actually identify high resistance liquidity scenarios or high resistance conditions in the market. And this is how you can navigate, and this is what you can use. The last ditch macro is one of the things that I normally use to get something, and you know, use minimal risk. So that's it from Saikido. I'll see you guys on the next one. Hope this was very insightful. Cheers.